You make money when you're working and you have patients coming into your practices and you're able to bill for that, right? But if you were a sole doctor, chiropractor with just patients and you were sick or you weren't able to perform for whatever reason, then you're not making that money. So that's a situation where you're a rich individual because you can make multi-seven figures in your work, but you are tied to the table to performing the adjustments to the patients.
Yeah.
But if you had a team of, let's say, 10 chiropractors that worked for you, you could be on vacation or you could be on a podcast like this and still be making money. So when you're making money while you're sleeping or not actively in the business, that's the difference between being wealthy versus being rich, where it's you're working your own hours in the business to actually produce that money.
Welcome to another episode of Chiro Kings podcast. We have a very exciting guest today, KC Chohan. And KC is the mastermind behind Together CFO, a firm that's renowned for its expertise in working with the high net worth business owners and family members. So the ultra rich people, he kind of gets down and tells us what are they doing differently from the rest of us, especially from a tax standpoint. He was born and raised in England, and now he's based in Beverly Hills, Los Angeles. He's become the secret weapon for CPAs and financial advisors, helping clients save millions on taxes through innovative and tailored strategies, which supersede the regular loopholes that even most people know about. He's a respected writer for Forbes magazine. KC's insights have been spotlighted in Entrepreneur magazine, NBC, Yahoo Finance, and Fox News. His engaging and informative style has also made him a sought-after speaker at high-profile events like the Accounting and Finance Conference, The Money Show, Quantum Mastermind, Amplify, and Market Disruptors, just to mention a few. KC, welcome to the show.
Wow, that was a hell of an introduction. Thanks so much.
Now you got to live up to it.
Absolutely.
So,
I like it.
Why don't you tell us a little bit about your company, KC, and who your target market is and how you serve them?
Yeah, so we are Together CFO, as you so beautifully put, and we help not just the elites, but high net worth business owners, a lot of doctors, take those advantages that they just don't know about because you're only as good as your team, right? And the generally what we see is you're with your CPA and accountant, bookkeepers for the longest time, which can be good, but it also can be bad because you're limited to how good or bad they are. Now, if you're starting your practice early days, that's probably okay. But by the time you've grown to multi-practices and multi-seven figures, you want to get a bigger and better team that can help you elevate all areas of your business, not just the tax savings, right? So we are one piece of that pie, and we bridge the gap between family offices all the way down to multi-seven-figure entrepreneurs, mainly business owners, a lot of doctors specifically, a lot of lawyers, a lot of high-earning business owners that are multi-seven figures. And what we do differently is something called the strategic giving blueprint. Because we have all heard of loopholes, and there's so many different loopholes that all of us should be using, and there's new ones that have just been implemented or about to be implemented with this new bill. So they're always changing at any given time. There's new ones coming in, there's old ones going out, but they're often at a lower level. You can't really get down to a single-digit tax rate by using loopholes if you're a multi-7, 8-figure entrepreneur. And that's where strategic giving comes in. It's that next level above. Once all those loopholes have run out, that you can take your tax savings, your asset protection, and your legacy creation to the same structures that are used by family offices and billionaires.
What kind of people are using systems like yours? Like are we talking about like Bill Gates type of people, or what kind of people are we talking about?
Yeah, all the billionaires, Bill Gates, Warren Buffett, Jeff Bezos, Elon Musk, all of the billionaires, they all have private foundations. Now, they'll have multiple foundations. They'll have public foundations as well as private. There's a lot of different entities that these guys control. A private foundation is, again, it's just one piece of the overall bigger pie.
Okay, so just to give us a ballpark, like how much profit do you need to be making before you start looking at stuff like this?
Profit's a tough one. I tend to go off taxes paid. If you're paying over $400,000 a year in taxes, then if you create a private foundation, you could easily save a third of that. Just roughly speaking, as ballpark numbers.
Okay, that's good. That's
so
helpful.
At that point, it starts to become a six-figure a year saving, which is significant if you're able to invest that tax-free and compound it every single year tax-free.
Yeah.
It becomes really significant very, very quickly. So this is what the elites use, because they don't need to have $20,000 a month just to cover their own personal overhead. The personal overhead was covered many years ago, right?
Yeah.
So this is all a longevity play with a different perspective that they're looking at generationally compared to most people that are stuck paycheck to paycheck, right? So that's kind of the difference in the mindset.
Yeah. So your company doesn't necessarily focus on helping people get rich. You're helping them stay rich and build a legacy, really.
Very really well put. Yeah, there's a big difference between getting rich and becoming wealthy. And the difference is you guys very successful in your own niches, right? So you make money when you're working and you have patients coming into your practices and you're able to bill for that, right?
Mm-hmm.
But if you were a sole doctor, chiropractor with just patients, and you were sick or you weren't able to perform for whatever reason, then you're not making that money. So that's a situation where you're a rich individual because you can make multi-seven figures in your work, but you are tied to the table to performing the adjustments to the patients.
Yeah.
But if you had a team of, let's say, 10 chiropractors that worked for you, you could be on vacation or you could be on a podcast like this and still be making money. So when you're making money while you're sleeping or not actively in the business, that's the difference between being wealthy versus being rich, where it's you're working your own hours in the business to actually produce that money.
Right. So in other words, like rich is when you're still trading your time for your money. You're getting paid well for your time, but you're still trading your time for your money. And wealthy, you have assets that are creating passive income for you that are stable.
Exactly. Yeah. Very well put.
Awesome. So I kind of have a question for you. So I'm guaranteed we will have some wealthy individuals that are, making over $1 million a year and could use services like yours. But we also have a lot of chiropractors who might just be starting out, or maybe people who are very ambitious and want to be in those shoes someday. Can you give me an idea what kind of industries, or what do you notice about some of your clients? Because not all doctors make enough money to fall into that category, to say they're paying multiple hundreds of thousands of dollars in taxes. So you're dealing with people who are successful, who've made it. So even though you maybe weren't along with them on that journey, you can see what's different about them than other people. What kind of insights can you give us, the rest of us, to kind of know what set them apart? What's different about them? What decisions did they make? What industries were they in?
Yeah, it's an entrepreneurial spirit is very apparent amongst all of them. The one common trend across the board is that they are just born entrepreneurs, which is not very common for doctors, funnily enough, right? Doctors are very smart people, high intelligence, disciplined because they've been through so many years of education and then probably more years of education after that to get to where they are. It kind of goes against being an entrepreneur, which is more gung-ho, shoot from the hip. But they all seem to have some kind of spirit in them or drive in them for more desire. I don't quite know what to label it, but I don't think that's something you can train. I think you either have that or you don't have that.
It's like the vision and the hustle.
Yeah, that's a good way to frame it.
I feel like one of the detriments, at least when it comes to our profession, is people not understanding that talking money is an extraordinarily important part of this conversation. If you don't know your numbers and you don't know where you're losing money And I looked at our little pre-sheet here for our interview, and I saw how much money someone might be able to be leaving on the table by not taking advantage of some of these things. And I was hoping you could maybe speak to a company that is maybe having 3, 4, or 5 locations. And as we're scaling, where are we losing out on some of our procedures when it comes to taxes?
Yeah, that's a great question. We see this all the time, especially as people look to scale and expand. You want to start getting economies of scale in very early, especially as you get to like 3, 4, 5 locations, because at that point, you're going to be a target for a roll-up, and the multiple on which you exit for, if you did want to go down that route, would be highly impacted by very little things. So if you're what the main thing we see across the board is mixing in personal expenses with the business. So don't do that. And if you are going to do that, just do it on one line item. So it's very easy to take out of the calculation, so you know what your true business is performing versus your business plus questionable expenses, let's just call them. So that would be one thing. I would just control the way that it's created, because it can lead to a mess. We've seen some clients that have got thousands of transactions over the year of personal items that had to be then pulled out of their books and reclassified. And it is just a pain that you can just totally avoid very easily.
Yeah.
I think a lot of people do that, but that's one thing. And it makes your business look a lot better on paper too, right?
Well, the problem I think is a lot of when you're starting out, the doctors, they don't teach us this stuff in school. So people don't know what a P&L is. You're a doctor, you could do surgery, but you don't know how to read a P&L, and you don't know where, that line item should sit, right? So I had to take a whole class in my MBA course on corporate finance and learn about the different categories that sit on a P&L and where doctors, the doctors'
it's not even
owners'
corporate
expenses.
finance at that point. Needs to be a level of basic accounting 101, right? I think corporate finance is probably a little bit too advanced. But yeah, again, for people that are going into private practice, or they know that when they go into school that, hey, I want to eventually own my own practice, they should be doing exactly what you did there, is taking extra classes. You can take free classes online now. You don't even need to do it in school. A couple of hours worth of bookkeeping knowledge will get you so far, because otherwise you just have to depend on your team. And that's a risky scenario for anyone, right? You got to have at least a little bit of base knowledge so that you can ask the right questions. Otherwise, you are totally dependent on a bookkeeper that is probably very average at best, is missing things, and no one is correcting them until the end of the year, if the CPA is bothered enough to actually do a detailed dive in there. And then that issue just keeps compounding over multiple locations, over tens of millions of dollars. I'm being a little bit extreme
but
there,
it's true.
I think you get the gist.
Yeah. I mean, my situation was, I got hooked up with a good bookkeeper and CPA right out of school that only does doctors, and they've been great for me for a long time. But I did end up taking my bookkeeping away from them after I did my own research and took my MBA courses and everything, and learned more about finances. And what I realized was they were keeping me legal for tax purposes, but they weren't separating things out in a clear enough way for me, just simply because, the bookkeeper was doing all the categorizing in QuickBooks, and then the CPA just would come in at the end of the year and kind of, control it a little bit, clean it up, and then, but it wasn't in a way that was really giving me a lot of insight to my company. And plus they would clean it up so much later, after like a month end, that the data wasn't really useful to me. So what I ended up doing was recategorizing, all the stuff on my my P&L, where I had, all the doctor expenses were up in the COGS section up at the top, and then, all the office expenses in the SG&A section, and then I kept a bottom section for me that was like my personal owner's expenses that, are after the EBITDA. And so I had to learn all that stuff to figure out, okay, this is how it should be set up. And they never did that for me before. And now I have a bookkeeper and accountant on staff, And within a week of the end of the month, he's got it all cleaned up and ready to go and can give me my P&L and say, this is how things went last month. And now I'm able to make way better, timely decisions on my company.
Well, I was thinking that something that Casey said that I think applies here is that I think Dr. Matt outgrew his accounting firm, and that seems like a common thread with maybe some of your clients.
Definitely is the case. Now, they don't have to change bookkeepers and CPAs to work with us because we're very specialist in what we do. And in fact, a lot of CPAs and bookkeepers refer us business because they realize that, hey, client is paying a lot of money. It's not about my ego. I want them to actually save money. So maybe we should have this conversation and see how a strategic giving blueprint would save an additional 30%, right? So the good CPAs and the good bookkeepers know what they know, but also know what they don't know and refer in the next level when needed. But think of that for a second, Matt. That's quite scary, right? You had a specialist firm that only does doctors that you thought were doing really well, that were actually doing the bare minimum possible just to get by. But you didn't realize that until you educated yourself.
Yeah, exactly. I mean, how would I have known?
And that's a specialist firm, like you said, probably came from a referral of someone that you respect.
Yeah.
And they've probably been doing a good job, or he thinks at least a good job for them as well.
Yeah.
And we see this a lot all the time. And it's like, how would you know? Well, you could go to a few other firms and interview them and say, hey, I'm a doctor. This is what we do. This is where we are. How would you do it? And how does that compare? Show me the differences between what you would do and what I currently have, and what's the difference in pricing and the packages, right? So people don't do this. They don't interview multiple bookkeepers. They don't interview multiple CPAs. They do not ever test their CPAs.
Yeah.
Now, one of the free things that we do in our school communities, we've got the top 50 loopholes that everyone should be using. Going back to what you asked earlier about people that they're not quite there yet, everybody should be using as many loopholes as humanly possible, because this is the government saying, hey guys, we are going to incentivize you to do this activity, whether that's bonus depreciation, whether it's hiring your kids, whether it's travel, whatever.
Renting your house out 14 days out of the year, buying a vehicle over 7,000 pounds so you can get tax breaks, stuff like that, right?
Exactly. All of them. There's loads of them. So what we always recommend is to download that PDF, email it to your CPA and say, how many of these are we actually using? And the ones that we aren't using, explain to me why we aren't using them.
Yeah.
And if you don't get a satisfactory reply, or if you don't get a reply at all, I think it tells you everything that you need to know about your team.
Yeah.
And that PDF's readily available on your website, I would assume?
Yeah, it's in our community. So yeah, you can get it from our website. It just redirects you to our school group. It's school.com/tax. And we'll leave the links below for everyone.
Yeah, and we'll drop that in our podcast links as well.
To just piggyback off something you said earlier about constantly looking at your team and analyzing it and interviewing more people, something I'm learning in my MBA course right now is about the concept of Kaizen, which which is basically constant improvement. Small little improvements incrementally over time compound into, big changes. So if you're looking at everything you do in your company, whether it's finance or marketing or operations, and you're always like analyzing it, making little changes, looking to see how the changes affected it, and you make 10 little changes that all add up to really a big difference in the end. And I think that's what separates a lot of the great companies from the mediocre companies.
Yeah, and I think that kind of ties into...
A lot of the car companies do that.
Sorry, Casey.
Yeah.
A lot of the car manufacturing companies do that. My background is with an engineering company, so I went through Kaizen green belt training, so I'm very familiar with that.
Cool.
Yeah, I think that one of the concepts that we implement in our company is, we're starting to become a bigger ship, and little changes can help turn the ship rather than wait until it's too late and trying to hit a hard left. It just doesn't work. So constantly analyzing, I think, is super important.
Hey, Casey, do you guys do anything with R&D credits?
We don't personally. That's at a loophole level. But again, R&D credits is such a speciality thing that I would always recommend going to a firm that only specializes in R&D credits and doesn't do anything else, because it can get quite complex. And a lot of the times, if it isn't done correctly, it's not even worth doing or paying for the study at all.
Yeah. I've been using it for a few years now with a specialized company and done really well with with those. So. Anyways, just one more thing to look into. But so tell me a little bit more about the foundation. So these are all 501Cs. And
it's all a 501c3.
Okay.
And the main difference, there's two categories at that level of private foundation. One is public, which means it is soliciting donations from anyone. And the second one, the more powerful one, is private, which is an individual or a family or a set of people that are donating into that.
Okay.
And then the way it works is the money from, let's just say you have multiple practices, it all, in California at least, it's an S Corp, it flows to you directly. And then on your personal AGI, or the equivalent of net profit, it's 30% of that dollar value. So as an example, if you make $1 million a year personally after everything, then you can donate up to 30% to the foundation and get a full tax write-off for that. So then your taxable basis would go from $1 million down to $700,000. But on the flip side, you now have $300,000 that you fully control in a foundation that you can invest in the stock market or the gold or crypto, whatever you want to invest in for long-term planning.
Yeah, maybe we'll just put it all in Doge.
Yeah,
and see
put it
what
on
happens.
the Doge and ride it to the moon. No, okay, interesting. What are you finding? Do they talk to you very much about what they're doing with it after you set up the foundation? Do you help them with that?
Yeah, they try to, but again, we stay in our own lane. We are not wealth managers. We are not financial advisors. We do two things. We create the structure that you need to maximize the input into it. So as an example, if you wanted to donate more than 30%, there's additional, more complex ways to do that. And then after everything's approved, because we get a letter directly from the IRS saying that this is an approved entity, it is now tax exempt. And if you get that letter, you then have to follow a whole set of different rules and regulations. So we make sure that on an ongoing basis that the bookkeeping is done properly in the foundation, along with all the compliance, the board meetings, the minutes, and then the tax filing as well.
It's kind of like an SEC filing to some
service.
extent, right? Like there's some public,
It's a big
there's
filing.
certain things they have to comply with and post publicly. No, I don't know about a private one though.
It's
Does a private
awful.
one have to be posted publicly too?
That's why the audit rate is so low, because you
It's all out there
post
anyways.
everything up publicly.
Yeah.
Exactly. So there's very little wiggle room to do any shady things in there, although people still do. But it's a lot lower audit rate than an LLC or an S Corp or a C Corp.
Interesting. Yeah, I'm sure it's not to the extent of an SEC filing though, right? You don't have to have like a whole
No, it's
business
not that
plan
bad, but
and
it's
everything in
much
there.
more rigorous than an LLC and an S Corp.
Okay.
Should we maybe take a step back and hear a little bit more about Casey's story and how he got to where he is?
Yeah, let's do that.
All right, yeah. So as you already mentioned, born and raised in England, went to university, and then out of university ended up at the equivalent in America of a bookkeeping firm, like a CPA bookkeeping firm. Did about 6 months there and quickly realized it just wasn't for me, wasn't really a good fit for my personality or my interest. It was like watching paint dry, literally. It was very, very boring. So I was like, I can't spend the rest of my life doing this. There has to be more out there. So I ended up doing a lot of temp jobs because I was saving up money to go traveling around the world, which is very common in Europe. We take a gap year and we go see the world and go orange picking in Australia and loads of random stuff. Along the way, I ended up getting a temporary job at a big engineering company, and I was in the management accounting side of their business rather than like the CPA bookkeeping side of multiple businesses, which was a lot more fun and a lot more aligned with my personality. So I ended up getting a full-time job doing that, and then spending 8 years with the company, became one of the youngest financial controllers, got up to a region of Northern Europe, And then after I did that, I switched from Northern Europe to North America, which is how I ended up in LA. Funnily enough, the head office of the division that I was in LA. So it worked out fantastically. Didn't like the corporate America side of things. The company was very different in Europe versus here in America. So I was kind of counting the days down until I got my green card. And as soon as I did, I started my own company, and that was the genesis of Together CFO, which started off as a fractional CFO services company.
I was going to ask you about that, if that's what you guys did, but it's not that now, right?
Yeah.
Or is it?
It's pivoted. So yeah, that's where the next piece comes in. So what happened was with one of our early clients, we helped him scale from 5 million a year to 120 million a year.
Wow.
By adding the next vertical. And funnily enough, the vertical he added was a medical lab. And it completely blew all of our minds. Nobody was expecting that. But the byproduct of that was a huge tax bill.
Yeah.
So he kind of put me to work because I was part of the initial team that did all of this. And he's like, you got to figure out the tax situation. And I'm like, no, dude, I don't know anything about taxes because I'm a W-2 employee for a huge corporation. I'm English, so I don't even know anything about the tax laws. And then I've started my own company, so I go from W-2 to self-employed. And it's like, now I'm trying to fix this multi-million-dollar problem. And it was so far out of my comfort zone, you wouldn't believe it. But thankfully, he kind of bullied me into it and believed more in me than I believed in myself at that time, funnily enough, but quickly realized what to do. I went back to my old company, asked for some advice, leaned on my network, and figured out that a lot of these elites all have one thing in common, which is the private non-operating foundation. So we created that for him, and in the first year, he had around $12 million of tax savings by doing that.
Wow.
And then quickly realized that that's a much better niche to be in than CFO services, which is a very difficult sell for people because it means something different to everybody, really. If you're a startup versus someone who's trying to IPO or someone who's trying to raise money, a CFO could technically cover all of that spectrum. So it was much easier to niche into creating that same structure for successful business owners. And we've been doing that since 2017.
Wow.
That's
impressive.
Cool. Yeah. So do you guys have attorneys on staff? Because you're a CPA. Are you a CPA?
I'm the English equivalent of the CPA.
What do they call
so
what do they call that?
Yeah. CIMA. CIMA is what I did, but there's ACA. There's all these stupid acronyms that nobody really cares about.
So,
but we have a team of accountants, of lawyers, of researchers, all on staff.
Okay. How big is your company? How many people do you got?
We've got about 31 people right now.
Okay, cool. And do you guys do multiple different states? Does it matter what state somebody lives in?
Yeah, all across America. It doesn't matter what state they're in.
Okay, cool.
How much do you see this new tax bill changing what you do? Are you optimistic about what it presents for you, or does it become more challenging? How often do you have to pivot your strategies?
Almost never, because everything that this bill or the similar bills as well, let's not just group it to this one, they're all dealing with loophole level strategies. They're not changing structures. Now, if they came out and they said 501c3s or tax exempt entities are now no longer legal in America, they're gone.
Gotcha.
They're all abolished. That would impact everything, right? I would go to zero overnight. But they don't do that. They're like, hey, how do we help the middle class? How do we help the lower class? So, okay, well, tax on tips. Let's give the middle class depreciation write-offs. And they're all at a loophole level, not at a strategy or a structure level.
All right. Interesting. Very good.
I had a question about trusts. So I had set up a Delaware statutory trust. And so I can put, my properties in a child series underneath that and keep them protected and separate from, operating company. How is, what do you know about structures like that? Is that something that can be used in addition to what you do? And would the nonprofit have anything to do with the trust? Would it sit under it, or would it be a separate entity? And so those are some of the questions
Yeah,
I have.
I know a little bit about it. There's so many different types of trust. Firstly, there's like hundreds of them. The main reason to use a trust would be asset protection and maybe a little bit of estate planning too. It's not going to give you any tax benefits. So just know that if you're using a foundation, you get asset protection, you get estate planning, but you also get tax benefits too because you're in a tax exempt environment. So there's differences there. That's the first one.
So you wouldn't probably do both then.
You wouldn't need to do both, but it depends on what it all comes back as a step one to what is the purpose and the intent of what you're trying to do. Is it just get things out of your name? So in case you get sued, everyone likes to sue in this country, which is beyond me, but especially doctors. If they know you're a doctor and you've got multiple practices or a thriving practice, they'll try and sue you for no reason at all, just because they'll get a settlement value of maybe 50K, 100K, and it's not worth your hassle to fight that. It's better off just to pay it off and it'll go away, right? They know that game. So if you don't have any assets in your name, which is the smart thing to do, appear to be a ghost on paper, that is always a really smart strategy. How can you execute that strategy? A multitude of ways. You can use LLCs, you can use trusts, you can use foundations. So it's totally up to you which of those fit into your overall plan. But the underlying reason that you do that is asset protection, which is always a smart player.
Cool. I like it. Well, people work hard for their money. These entrepreneurs, these people with this intense vision and itch and hustle to grow these things, they work so hard to grow it. And then you always feel like the government's taking a big chunk of it, right? And some of these some of these people have kids and their families, and they want them to carry on. They don't want to get it all taken away when they die or move on. So obviously there's a motivation for that. What do you have to say about that? Like why should people care so much about their money and what's going to happen to them? I mean, I don't know. There's more.
Well, I think you said it in the first.
Yeah.
But I get what you mean. I get the sentiment. I get the question every day. And you said it in the first sentence of what you said. People work so hard for their money. Nobody's giving it to you, right? You're in a very competitive environment and you've succeeded and you're doing really well because that means you're good at what you do, right? So why should you lose up to half of that on estate planning taxes, probate taxes, death taxes, just because you've expired? You shouldn't, but you should plan accordingly so you don't. You know the rules, they're out there, they're very black and white. It can, and this happens across the board. This is not just middle-class people that don't do this. There's rich celebrities that, let's use Chadwick Boseman as an example. Recently, the guy from Black Panther, he died of cancer, right? Unfortunately. But he didn't have his estate planning done. He knew he was dying of cancer. But his family ended up losing out on millions of dollars of his estate because he didn't have a plan in place. Mm. Now, most of us don't have that luxury of knowing, hey, when we're going to die, if it is even a luxury, but we don't know when we're going to die, generally speaking. Yeah. But we can all plan to know that, hey, eventually, one day we will die. We know that with certainty. That's why life insurance pays so much, right? And you can borrow against it as a great asset tool. But there's no excuse for not doing it because we all know the inevitable will happen one day. And then it comes down to, hey, I'm busy. Hey, life got caught up and this and that. There's always an excuse. But really, the bottom line is, and the more wealth you create, the more important this is. If you're only leaving a couple of $100 or a couple of $1,000 for your loved ones, not really a big deal. But we're talking about successful business owners. They've got multiple assets. We're talking millions, if not tens of millions here. And then the thresholds keep changing, back to loopholes, right? So the estate planning threshold used to be $5 million on gift taxing, anything above that. Now it's $13 million. And the talk is it's going to go down to 6 or 7 million next year. So
So tell us
again,
what
back
that
to
means. Tell
loopholes.
us what that means exactly.
So for the first, right, let's just use today. For the first $13 million of assets that you give to your kids,
When you die.
that is tax free.
Okay.
But then after that, it can go up to 40%. And that threshold is now going down. So we know it's going to either 6 or 7 million. So it's significantly reducing.
Yeah, that's
And that could be a big problem for high net worth people.
Yeah. So, okay, I have an interesting question. Your kids. This maybe is less of a tax question. Do you have any kids yourself?
I do.
Yeah.
I've got my firstborn is nearly 2.
All right. What do you think about rich kids? Right, their parents they did really well, and now they're leaving this money to them. And how does the foundation play into that as well? Like, a lot of people say, oh, most people will squander it within a generation or two. The money will be gone.
3 generations.
3 generations. Okay, you knew it.
Yeah.
3 generations will be gone. Does the foundation change that at all? And is there any things you would do with your kids if you were, I don't know your financial situation, but if you end up being in that situation where you have a lot to give to your kids?
Yeah, great question. And that's my favorite piece of the foundation. When we look at the benefits of having a foundation, it kind of falls into 4 categories. 1 is the taxes, 2, asset protection, 3, totally eliminates capital gains tax. But the 4th one is the legacy play. So the legacy is my favorite piece because this is how the elite families like the Rockefellers and the Rothschilds and all these billionaires, they keep their family really close, specifically in the board meetings of the foundations. So the kids from a very young age are sitting in, think of it as a big room. The kids will sit in on the outside of the room just listening in early and getting a grip of, hey, this is how a board meeting runs. It has an agenda. We're going over these points. It's very clear what we're doing. And then they'll ascend towards this inner table, think of it like that, to a point at which maybe they're in their 20s or late teens, depending on how they are. And then they can sit at the table, they can ask questions, they can take the meeting minutes themselves, they can get more and more involved with the family foundation. And this is where you pass or you transfer knowledge from generation 1 to generation 2, because the studies clearly show that I think it's 83% of wealth is dissipated by generation 3. So the person who's made the wealth creates it and does a good job. The child of that person manages to maintain it to a certain degree, but by the time the grandkids come around, they have no idea how hard grandpa worked to make the money and dad did an all right job of keeping it, but now I'm just going to blow it all.
Oh, man.
And that's what we see time and time again. So to get the kids and then the grandkids and then continuing on in the lineage involved very early in the foundation helps them see the hard work that went into building that, and then the family philosophy about maintaining it and and again, back to what we said earlier, going from being rich and working really hard to becoming wealthy. It's different problems when you're wealthy, because when you're wealthy, you just don't want to mess it up.
Yeah.
When you're rich, you're going to take more risks to kind of grow. But when you're wealthy, it's a different mindset of, hey, we've got this big nest egg, it's producing, now we just can't mess this up. So the mentality shifts. But if you haven't created it, or you don't know the amount of pain that went into creating it, and you're just spending it, it's very easy just to keep spending until it's all gone, similar to like the Vanderbilts.
Yeah, I've heard it's been said with a company that people will spend the company. It's in the nature of a company to spend everything that it has in its account, and I think that's probably similar for people as well. I know for me, I don't want to just leave a bunch of money in my checking account. If I happen to get a bunch of money
working for you.
Yeah, for one, it's not that it's just not working for me, is that I will spend it. So if I get money from something, like one of my investments pays out and I get 50 grand or something, I don't just let it sit in my checking account. Like I'm squirreling it away somewhere where I can't spend it.
Yeah. Yeah. That grandkid is looking at that account and says, I think Doge is going to hit big.
Yeah. They don't know what it took to get it, so they're gonna spend it too quick, I think. So let me ask you this. So we're talking about 501c3s. These are nonprofit foundations. So you put some money into it. It's making its own investments, and that money goes back into the foundation, and you don't have to pay taxes on it. And
so there is a little caveat there.
Okay.
So it pays a tax rate of 1.39%.
Too much.
I know. I know, but you've got to put it out there. So on passive income that it receives, let's say from stock or from real estate or whatever, any passive investment, it pays a 1.39% tax rate. So
okay.
I apologize for all those people that I get into a 1% tax rate, but yes, you have to pay it.
Okay, so the money comes in, you pay 1.3 on it. It's building. I guess this is two questions. One, as a nonprofit, does it need to provide some sort of service to the community? And two, how do you actually utilize the money that's in there? You know what I mean? Like, yeah, cool, it's growing, it's doing its thing, but how are you then using that to live off of and spend and stuff without getting taxed?
Yeah,
or do you have to pull it out at some point and pay taxes on it?
You can. So there's multiple ways to skin the cat. Let's answer the first piece first, then we'll get into the second one. So the first piece was the money goes in.
If it's a nonprofit, do you have to give money to homeless shelters and
Yeah,
I mean, you should be if you're that rich anyways, to be clear. You should be, I think you should be taking on philanthropy. But my point is, what are the rules and regulations surrounding that?
Yeah, the rules and regulations for each nonprofit to be approved, it has to have something that's called a mission and a purpose, right? So as long as the foundation is following the charter that's written for the mission and the purpose, and that mission and purpose can be very, very broad, or it can be very, very narrow. So as an example, let's give a narrow one. So you guys could do a mission and a purpose to help support your local community with a chiropractic readjustment every Monday afternoon between 3 p.m. and 4 p.m. Right? Okay. That's very specific. There's not many write-offs. There's not many incentives in that small window scenario versus if you want to help keep the world healthy through education, science, and
philosophy of chiropractic
globally. Yeah. So now you can write the mission and the purpose so broad that it can apply to you going to a trip to the Vatican to see if you want to donate there. Or it could be a trip to Europe just to go visit some ruins or some spine center that you might want to do an event with or whatever. It can be written in a way that you can do a lot more broader activities than just that adjustment at Monday at 3 p.m. in your office.
Gotcha. So
mission and purpose is one.
So like if in my chiropractic business, if I'm going to write off a trip, let's say, I've been told, yeah, you can write off a trip if it's a business trip. And I go, okay, well, what if it's business and pleasure? It's like, okay, well, the parts of it that are business you can write off, and the parts of it that are pleasure you can't. It's kind of like how I've had it explained to me. And then I go, well, what about the gray areas? And the way I've had it explained to me is, well, can you justify that whatever activity you were doing directly impacted your business, right? Like if I were to say, oh, I'm going to buy a boat because well, what are you doing with that boat? Are you taking clients out on that boat? And then are you, wining and dining them and they're signing up with you? Can you prove that? Or are you just only going out with your family all the time? And so that's I think, is it the same kind of mentality with the nonprofit? Only you can just write a much broader, charter, and then so it's a lot easier to cover. Is that the idea?
Yeah, that's exactly right. So everything that you just mentioned is spot on there. So we have clients that have their jets and their yachts. I have my cars in the foundation. So that's all perfectly fine as long as you are doing foundation work. So that could be us talking on this podcast about foundations. For me, is foundation work because I'm educating people on foundations, right?
Yeah.
Right.
That's part of my mission and purpose in my foundation.
So there can be some overlap
So-
between your actual work and your foundation, like your paying job and your
Absolutely.
foundation. And then, do you have to proportion it? I know, like if you do have a car in your foundation, do you have to like track mileage and be like, oh, 50% of the car was used for foundation and 50% of it was personal, or is it a little more lenient than?
It's actually the opposite. If an asset is in the foundation, it should only be used for foundation purposes.
Okay. So you might have to
whereas
pick
you
and
can do
choose
that
what's going to be used. So there might be times then that you or your kids want to pull money out of the foundation because you want money to live off of, and it's there's no way you're going to justify that to be a foundation expense.
And you can take a payroll expense out of that, the foundation. The foundation can pay you, it can pay your kids, it can pay your family members, a reasonable compensation. So what is reasonable in the Bill and Melinda Gates Foundation is millions of dollars to all of their board members. That might not be reasonable to us if we don't have millions in our foundation, right? So make it reasonable. You can pay your family. That's not a problem. But then also you can use advanced tools like insurance. We touched on it earlier, but insurance products are often very underused. You can even use crypto. I know. I know Chris likes crypto.
You gotta try your luck
can use
sometime,
crypto,
man.
yeah, and leverage against it. So there's ways and tools to take money out, but that's not really the money that we should be putting into this. If we go back to the root cause of what we're doing, is a percentage of the money that we make is going into this that we want to use for long-term investments and long-term planning and just for our future generations. It's not the money that we need to live on day to day. That shouldn't really go into the foundation.
The legacy money.
That should stay with you first.
Yeah, the legacy.
So let me ask you this. So if some of our listeners right now might be going, this sounds pretty good, sign me up. So those in that group, of course, the next questions are going to be asked. How much does it cost to set something like this up, and how long does it take?
So it's a lot cheaper than using the big boys. So if you go to the UBS or Morgan Stanley's and the big boys, I've heard they charge up to $5 million to set these types of structures up for people. And operate them, not just set up, but set up and operation.
Yeah, I guess that's
they have
the
a
next
huge
question,
overhead.
is how
right?
much is a yearly operation maintenance of something?
Yeah, so we're a lot more reasonable than the $5 million. We can get it done at a basic level for $50K, and then if there's more entities and complexity involved, maybe a little bit more. It could go up to $100K max. I can't imagine it being more than that. And then on an ongoing management maintenance, it's a percentage of the assets that are in the foundation. So similar to like a wealth manager. The more assets you have in there, the lower the percentage is.
Give me a range.
5 and lower.
Okay.
5% and lower.
Okay. And then how long does it take to set something up?
If we move quickly, we can have everything submitted within a week. And then you can get up and running by that point. But it usually takes a month or 2 months to get the letter back from the IRS, the approval.
Okay. That's a couple of months. That's not bad.
Yeah, that's a quick turnover.
Nice. Now, is it only individuals doing this, or are there companies doing this too, or is it
No, this is all individual.
Just a
this is not a
family
corporation.
doing it, basically?
Yeah, it's a single family or like brothers and sisters.
Yeah. But
Family.
people related.
Yeah.
Okay, cool. Is there any other questions we should be asking you?
Well, I think our targeted audience for this is, of course, chiropractors and chiropractic students. So maybe asking what the most common mistakes that people at different levels might be making. If you have one clinic that's successful, you haven't scaled it yet, what are those people doing wrong? Versus someone who is at the verge of having 10 offices, what they might be doing wrong. I think that'd be an interesting conversation.
Yeah, no, great question. So to start with, let's give something to the W-2 employees, because I'm sure there's some of them listening too. Everything that we talked about in a private foundation and getting a 30% tax deduction can also be done at a W-2 level, pre-tax. So if you're an employee and you're making, let's just use $1 million as a simple example, but you can prorate this however you wish. You can donate 30% of that top line income that you make pre-tax into the foundation to reduce your taxable take home. So the same mechanism that we talked about for the individual business owner, but it also applies for the W-2 employee. So we also get high paid doctors that are like on a partner track at a hospital, but they're a W-2 until they make it and then it switches over. And then we also get a lot of lawyers that at a big legal firms and they have settlements and they make a lot of money, but again, it's W-2, so they get crushed on taxes. Those people can also use the private foundation and the donation mechanism to get their tax rate down by 35% quite easily.
Wow. That's pretty powerful.
Now to answer, is really, and again, people don't know this. CPAs don't know this as well. So it's kind of shocking because if somebody said to you, hey, if we create this structure once, you can save 30% every single year on your tax bill, and your wife can too, and your kids can too, and your brothers and sisters can too, it soon becomes really, really attractive very quickly, right? Then to answer the next question, Chris, if you're a small business, let's say starting off in your practice, there's two main things that really matter here. One is the top line revenue. What are you doing to get the marketing dialed in so you're getting the right types of patients in, whether that's insurance, whether that's PI, whether it's ads. And then the second is, what are you doing to not waste all that money in the middle piece of the P&L and the expenses section so that the net profit is directly in proportion at a good percentage to the revenue, right? So I think they're the two things I would focus on. Is internally you can control your business P&L line by line. Very, very similar to what actually Matt said earlier. Is educate yourself. Go watch a 10-minute YouTube video on an explanation on what a P&L and a balance sheet and what cash flow is, because a lot of people don't even know the difference between the net profit and the cash flow. It's very different. They're two different numbers, right?
Yep.
So, and that is the number one killer of businesses in America. It isn't profitability. It's actually cash flow, because people don't understand their working capital cycles. And I don't want to geek out on all the accounting stuff,
I could
but
geek out
that's
with you
really
on like quick ratios and stuff like that. People need to know.
Yeah,
You
got
could
it.
be showing a
tips and a
profit,
little
but you cannot have any money in the bank. In fact, there was just an accountant I saw on Instagram the other day was saying the most important thing you need to know is your profit, and that's how much money you have in the bank. And I was like, no.
Well, he's assuming cash basis.
Yeah, well, I guess
So
you're a
that's-
cash basis, but still.
But still, it's not a way to run a business. But what we use is a tool called financialfusion.io. It's actually a software that I developed. I'll give you guys and your listeners a free coupon code to use as well. We'll put the link below. But financialfusion.io is a specific tool that gives you a monthly performance report, and it breaks down by subsection through P&L, balance sheet, cash flow, month to date performance, year on year, quarter on quarter. But then it does one thing extra. It has an AI CFO component that you can actually talk to when you get home after you've put the kids down to dinner and you've got an hour to look at your business. You can type to it, talk to it as if it was your actual CFO. Plugs into your QuickBooks.
AI CFO.
Yeah, cool. It's an AI CFO that you can literally just help you, one, understand what's going on with your business, so you can make better decisions quicker.
Wow.
So, that's pretty powerful. Been working on that for a minute.
Where else have you seen AI impact your day-to-day or your vision for your 5-year plan?
That's a good question, because I want to add on to that, because certain industries, and finance is one of them, they say AI is going to cut out a lot of jobs. How do you feel like that's going to change things for you going forward?
Yeah, I totally agree. And you can see the inception of that through bookkeeping. So AI can come in and it can clean up a lot of things very quickly, right? So we talked about bookkeeping, transactions, and coding earlier.
Like it
There's
can do
software out
controlling
there.
now, basically.
Yeah, it can literally code all of your transactions correctly if set up well, so that you can probably replace your bookkeeper if you have a semi decent knowledge of bookkeeping. So that could save, I don't know how much you guys pay your bookkeepers, but about $1,000 a month, give or take.
Yeah.
And then it's only going to get better, because then there's already tools out there where you can throw your tax return into it. It can analyze it. It can see what deductions you've taken, what you should have taken. Like, it's only as good as the information you give it, right? I think that's the thing. And then the other problem is, if you don't want to put your tax return into ChatGPT because it becomes public information, right?
Well, they say
So
they don't
unless
share
you've got
it,
a
but
private,
supposedly.
I don't trust a word. Yeah. Right? So unless you've got a private server in your own office and it's secure and you can control it, I wouldn't be doing any of that with my financial information.
Yeah,
I'd be
maybe
very
the more
skeptical
enterprise,
about that.
the enterprise version of ChatGPT, possibly.
Yeah, but generally speaking, I think AI is going to revolutionize the world in the way that we went from the manufacturing industry to the service industry to the dot-com boom. Now it's going from the dot-com boom into a prompting boom that you don't even need to be a coder anymore. You can just speak what you want and it will create it, to a point at which it is going to get much, much smarter than humans. So who knows what's going to happen when we reach that singularity. But for me personally, my business, because we are high net worth and we are boutique, high touch, I don't think it's going to impact us as quickly as it's going to impact the bookkeeper that's just transactional, that doesn't even speak to the end user, who's just literally crunching a number and sending you an email, hey, your books are done. That level of transactional relationship can get wiped out real quick. Whereas what we do is more, we're speaking to you about your family and about your generational wealth and how to structure this and keep it. I think AI is a little bit... I don't think many people want to speak to an AI about that right now. Maybe in the future, AI assisted, and then. But I think we've got some time on that.
Well, ChatGPT 5 is coming out, I think, in the fall, and it's supposed to have empathy built into it in different emotional aspects. So that might get better. But that being said, I think personal branding is very important. So like Gary Vaynerchuk is really into AI right now and talking about that all the time, and how the one thing that AI can't take away from you is your personal brand. So that, like you were saying, that relationship that you have with the customer, AI will get better at it, but it's not going to be able to be a real person like you and I that can sit and talk with somebody. And if you've got your personal brand established before AI takes over, you're going to be in a lot better situation than trying to do it afterwards.
Yeah, 100%. Yeah, I think so. And then to answer the next question, you mentioned, so that helps the people at W2 and the smaller startup type practice. The person who's then scaling to multiple practices has got different issues. They're more focused on building a team. I think that's more important when you get to a bigger offices and multiple offices. Is, are you cross-training your team so that if somebody leaves, you're not down, you're not having to do it yourself, and that one person can go from one office to another office and help out. All the SOPs are written. And again, using AI, that's a great way to use AI to have SOPs written in a document, have a flow chart created. A human would probably have to make a little video talking through it if you wanted
they
that.
They can even do that
but
now.
Just to have, yeah, probably HeyGen and 11 Labs, you could do pretty much anything. But to have that level of documentation and a team and then a bench behind it, that if somebody did leave, it wouldn't cripple the business as you scale from one office to 10 offices, is really good. And it's tough. It's a different type of challenge, but then you become a target for the PE firms and the VC firms that just want to do a roll up, which makes sense because the multiples that you would get as a roll up far exceed you selling your practice as an individual. So if there's anyone out there who's like a boomer or kind of contemplating the exit side of things, look into getting into a roll-up, because you can probably get a 5x, 6x multiple compared to like a 3 or a 2.
Yeah. Well, what about this? Because I think about this sometimes. I just don't know if the roll-up payout would be enough to, like, you know, put me at the status that I would want to be at. What about just hanging on to it and getting funding, and then not selling it, and just you rolling up other people? You know what I mean? I don't know. Rather than selling off, I get 10 clinics and sell it off.
Cash cow?
Get some kind of funding, and then go from 10 to 50 or 100.
Yeah, it depends on your drive. It's all back to, firstly, there's no right or wrong here, right? Some people never want to retire, and other people want to retire as soon as they can. What are you going to do when you sell it anyway? You know, there's a lot of people going into depression when they have no human interaction or purpose. So there's multiple ways to look at it. But I would say that you got to analyze what you want out of life. Again, it's a deeper question than, hey, should I sell or should I not sell? Or what value do I sell? It's who you are. What is it that you want to do? What's lined up next as well? Because if you go from, hey, I'm working across all my practices and I love it, I'm thriving, what would I do if I sold this and I wasn't doing this anymore? Would I have to talk to my wife? Would I have to like golf all day?
You might find me in Cabo fishing. I might do okay.
I mean, I definitely want to retire at some point and travel with my wife, but my kids are still young, and you know, I'm need to work, you know. Yeah. I want to, and I have a lot of drive and passion for it. So that's
what I was going to say. I find a lot of purpose in my job, so I wouldn't want to just ditch it if I could just get paid out.
It's a hard question.
What you guys do,
right?
It's a hard question, because people do ask when you start getting a few clinics going. You know, I have 5 now, and people are like, "Oh, you have 5? How many do you want?" And I'm like, I don't know, as many as possible, I guess. I mean, I don't want to limit myself, but it's not that I don't think about it. It's just I still got gas in the tank, you know, and I still want to grow it. So I guess just grow it as big as possible. I mean, there are benchmarks where I think it does start to make sense to sell. Like, I wouldn't want to quite sell yet. I want to get like he said, get my systems down a little better, get my team built up.
But you could get into like a shared service. Like if they're all on the same software, they all do the exact same systems and processes. And then you can hire a professional team.
Yeah.
And then you get your management team that manages them all. And then step by step, you kind of step away so that you can go down, let's say, from 5 days a week to 3 days a week, spend some more time with the wife and kids, or, you know, soccer practice, whatever that looks like for you. But the minute you get, let's just say, a C-suite of management team in, and them all on the same systems and processes, softwares, you now become really, really attractive to be taken over.
There's price points too, right? Revenue. Like I've heard, once you start getting around
EBITDA,
around the $10 million, you know, I don't know if that's revenue or EBITDA, but the multipliers start getting bigger at certain benchmarks, right?
Massive. And then if you go the long route and you go IPO, you can like probably triple or quadruple the EBITDA again.
Oh, yeah.
Multiple again.
Once you go public, the ease of making a transaction makes something more valuable, right? So when you go public, the fact that somebody can buy a stock and sell a stock that easily, it makes your product. You could have the same exact company, and the day it's not public to the day it's public, it's more valuable because of how liquid it is, right?
It's scary. Like if you look at the numbers on that, if let's just use hypothetical so people can kind of get an idea. Let's say if you sold your practice, you could sell it at a 3x multiple of EBITDA. Let's say if you did a roll up, let's say it could be 7x. If you did an IPO, you're talking 20 plus X.
Sheesh. Yeah, and by the time you get big enough to IPO anyways, and then add 20 on it,
then we have 3 foundations, and we're all working together.
Crazy.
Yeah, I feel like you and I could talk about some fun stuff for a little while.
Absolutely, we need to get a drink going. Then at that point, get off the coffee, and we'll get a cigar and a whiskey going, and we could shoot the shit.
Next time you're up in the Bay, or I go down to LA, we're not too far away from each other.
Sounds awesome.
Absolutely, that would be cool.
I want in.
All right, man, we'll do it. Okay, well, we
can talk crypto. Don't worry.
Yeah, there we go. We really appreciate you spending the time with us. Actually, you and I hadn't really known each other, so this was pretty cool. It was a lot. I was expecting to be good, but it was even better than I thought.
This was all nuggets, and we appreciate your time, KC. Thank you very much.
Well, I'm glad I added some value and happy to come on anytime you guys like.
How can people reach out to you?
TogetherCFO.com is the company's website, or you can type in KC Chohan across all social media platforms. I'm quite active on LinkedIn as well.
Okay, sounds great. Well, thank you again. Take care.
Bye, everybody.
All right.